What if just $10 a day could build you hundreds of thousands of dollars? I ran a 30-year simulation on the S&P 500 and the results were a lot bigger than you might expect. With ETFs like SPY and VOO making investing easier than ever, I'll show you why consistent, simple investing could be the ultimate wealth hack and how you can start today. When I first started investing, I was scared of making a mistake. I didn't have a lot of money, and the idea of losing it stressed me out. That's when I discovered dollar cost averaging, a simple strategy where you invest the same amount of money at set intervals, whether that's daily, weekly, or monthly. Since the markets are open about 250 days a year, $10 a day would add up to just $2,500 over a full year, a number that actually felt achievable. But then came my next problem. How do you even pick the right stocks? There were so many options, and honestly, I didn't feel confident just choosing a few. That's when I found the S&P 500 index, a collection of 500 of America's largest companies. And while that might sound complicated, it's actually easy to invest in. Using ETFs like SPY and VOO, they bundle all these companies into one simple purchase. So now I had a plan: invest small amounts consistently into a diversified group of companies. But I still wondered, what if you invested daily instead of monthly or weekly? Would daily investing really make a difference over time? And that's what brings us here today. I ran the numbers and now I'm going to show you what $10 a day into the S&P 500 over the past 30 years could have actually turned into. SPY is one of the first S&P 500 ETFs, launched in January 1993 at around $43 per share. Move forward just 10 years later, and you would have invested about $25,000 of your own money, and your portfolio would be worth around $28,000, about a 12.7% gain. It might not seem like much at first, but remember, by 2002, the dot-com bubble had burst, crashing tech stocks and dragging the overall market down. Even after a massive sell-off, staying consistent meant that your investment came out positive. Now fast forward to 20 years later, you would have invested about $50,000 total, and your portfolio would have grown to around $81,000, about a 60% return. Again, this wasn't an easy ride. In 2008, the market crashed during the global financial crisis, one of the worst recessions in modern history, but once again, staying consistent paid off. And finally, fast forward to today. You would have invested about $81,000 of your own money, but your portfolio, it would now be worth around $350,000, a 330% return on your contributions. And remember, you would have also survived the pandemic crash in 2020, when markets plummeted almost overnight. Through all the ups and downs, just $10 a day would have grown into something quite life-changing. And when you look back, it's crazy to realize those massive crashes, like the dot-com bubble, the 2008 financial crisis, and even the COVID-19 pandemic, they felt huge in the moment. But when you zoom out across 30 years, they barely make a dent in the long-term trend. And that's the real power of staying consistent, even when everything feels uncertain. But then I thought, what if you didn't just invest daily? Would weekly or monthly investments have done just as well? Let's take a look. These tables break it all down, showing the contribution frequency, the total amount invested, and the final returns. Across these timelines, the percent returns were surprisingly close. In the 10-year simulation, daily investing came out slightly ahead. In the 20-year timeline, weekly investing led by a small margin. And over 30 years, monthly investing would have performed the best. There wasn't a clear winner, but that's the point. No matter which style you picked, staying consistent turned even small investments into something powerful. And now, we've answered our question, not just how $10 a day would grow over 30 years, but also how it stacks up against weekly and monthly investing.